Welcome to Financially Speaking, brought to you by Buska Retirement Solutions and its affiliate firms. We offer retirement, tax, and legacy planning from a dedicated family-built team. Today, we'll explore how the One Big Beautiful Bill Act and recent IRS guidance are changing the rules around retirement catch-up contributions, and what you can do to avoid lifestyle inflation in your life. And now for our weekly question and answer segment.
Welcome back to Financially Speaking, where I'm joined by Ryan Pekka and Ryan Connor from Buska Retirement Solutions to explore how the One Big Beautiful Bill Act and recent IRS guidance are changing the rules around retirement catch-up contributions. Gentlemen, thanks for joining me today.
Of course, thank you.
Good, we're talking about catch-up contributions today, which is something I think a lot of people hear but don't really understand it. So let's start with, what even are catch-up contributions, and how were they changing?
Yeah, so catch-up contributions have been a part of prior tax policy before. Kind of the old rules is that once you reached age 50, you were able to contribute more money into both your employer-sponsored retirement plans, so like your 401ks, your 403bs, as well as your own individual retirement accounts, whether that be a pre-tax traditional IRA or a Roth IRA. So under the old guidelines, and this is still the case, at age 50, you could contribute an additional $7,500 a year into your 401ks and an additional $1,000 into your IRAs.
On top of the old
contributions.
Okay.
And so it allows you to, the idea behind the catch-up contribution is basically as you get into your higher earnings years, which are generally going to be kind of your 50s prior to retirement.
More so once my kids are out of the house.
Yes, and the big thing is once your expenses can drop, hopefully once those kids are starting to trickle out of the house,
right,
that you're able to then kind of catch up on maybe contributions that you couldn't have made because of expenses or lesser income earlier in your career. You know, in your 30s and in your 40s, it's going to be pretty expensive between, child care, child activities. Your earnings are generally going to be a little bit lower as you're kind of still relatively earlier in your career. So by having these catch-up contributions and expanding what people are able to contribute into them, the government kind of incentivizes savers to ramp things up as they get closer to retirement so that they are able to retire on a timeline that they'd like.
Got it. And now there's the changes to it, but then there's a super catch-up now. And that's for people ages 60 to 63, if my memory serves me correctly. What is that about, and when does that take place?
Yep, so you are correct. It is going to be between ages 60 and 63, kind of this super catch-up. So this is actually for folks who are already technically, according to tax law, of potential retirement age. That starts at 59 and a half for most of your IRAs, your employer plans. This allows folks to kind of really throw quite a bit of more money. It's over $11,000 a year on top of the contribution limits as they already exist. And so that will allow folks who are very close to retirement to kind of make that final push. Those, highest earning years, where they're probably in the most senior position that they'll be in their working career, be able to pile as much money from a tax advantage perspective as they can during those periods into those retirement accounts, so they can, again, try and retire on a timeline that they'd like. Kind of gives you that final push before you retire.
Okay. And why are high income earners now required to make catch-up contributions as Roth contributions instead of pre-tax in a normal IRA?
I think the short answer there is the government wants their tax money. That's really it.
What?
So there are already limits in place to traditional and Roth IRAs and how you can make those contributions, and Roth typically phases out for a certain point. Really what they're saying is the government doesn't want you to get another tax deduction as that higher earner. They want to say pay your taxes now, you can let it grow tax deferred. That's really the easy answer there. It just makes it more straightforward, helps you kind of stay in the tax bracket you're already in. So really they're just guiding you to the correct vehicle for, in their mind, your savings account.
Also theirs.
Yeah, yes.
Got it.
It's an advantage, pros and cons to that. Obviously when you're planning, it's good to have both. So I think for high income earners, it's not the end of the world. It just limits their kind of tax approach.
Sure. And what happens if an employer's plan doesn't offer a Roth option? Like my employer has a 401k but not a Roth. Can employees still make catch-up contributions like that if I don't have that Roth option?
Yeah, so under current guidance, the kind of short answer seems to be no, that you're not able to do that. Just under current guidance that the IRS has provided for that. Like Ryan was talking about, one of the reasons, especially for high income earners, is because they want to, make sure that you are paying taxes on those dollars when your income is probably higher while you're still working. One of the common things that you'll see, and I think this is particularly the case for high income earners especially, is that the effective tax rate on their money is going to be higher during their working years than it will be in retirement.
That's true.
Oftentimes because they've been able to put money into various different kind of post-tax accounts, and also their expenses in retirement are probably going to be lower than they were for a lot of their working years. We talked earlier in the segment about kids and how expensive they can be. But also in retirement, you'll have things like, your mortgage payment may fall off your expenses sheet. So, all kind of those different things working together to ultimately make it, where your flexibility is going to be a little bit restricted depending on your income situation.
Sure.
But that's why it's something where, working with someone who has experience with the various, tax law, understands the implications that that's going to have in terms of long-term planning is going to be really important. Because as these new laws come online, some of it, like the most recent one we just talked about, is also open to interpretation guidance from the IRS. And so that guidance, says one thing in 2025, might have a different interpretation by 2028 or 2029.
So the rules are set, but there still can be kind of muddy and unclear.
Yeah, I mean, one of the things that happens with policy is that so much of it is interpreted by, the executive branch in terms of how they want to implement it.
Right.
And so guidance around that can change over the course of time.
Why do you think there are contributions in general? Why do they put a contribution limit on a 35-year-old?
I think the short answer again is taxes. Again, if you can defer any income you don't need, the government doesn't collect taxes on it in that year. So these plans already have rules around it. Even the super catch-up is optional. Plans don't even have to offer that to them because it's not everyone's lumped into that group since it's only 60 to 63. They're already optional. When you look at it, it's really just going to be about when the government wants to collect taxes and how. Obviously, the debt and deficits play a big part of that. They want to kind of have a good idea of how much taxes they're going to collect. If you tell me I can defer as much of it as I don't need, they're going to have a smaller bucket to pull from.
All right, so they're not much different than us. They want to know where their income's coming from.
Yeah, absolutely.
So on the income coming from it then, I'm approaching retirement. I'm 60 years old. I can make, let's say 50 now. I can make catch-up contributions. I can put in my Roth, my IRA, my 401k. Oftentimes you mentioned you have other accounts, my brokerage account, I got CDs at the bank, like I got stuff all over
You're
the
well
place.
diversified.
Well, we call it scattered in my life. But how does one go about choosing which one to put money in? At some point, if you're putting in an IRA, you're putting it in, getting the tax deduction to turn around, take it back out. How does one pick on where to put it?
Yeah, I mean, the most important thing that we're looking at when it comes to that in my experience, is also when you're actually looking to retire. Because one of the most important things, and it's a very significant topic right now, is going to be like health insurance coverage.
Sure.
If you're looking at retiring before 65, you need to have a very clear plan about where your income is going to come from. Because if it is coming from like taxable sources, whether that be traditional IRA, 401k, even your brokerage account as well, if you've got capital gains there, that's going to count in that calculation when it's looking at things that are going to impact like your health insurance premiums. So one of the single most important thing, and it's often our answer with a lot of this, is you should sit down and do really comprehensive planning, because all of the minutia around tax law, around healthcare policy, are all going to be very expensive decisions, potentially that you don't want to make a mistake on. So doing that kind of comprehensive planning is really important to make sure that you're not missing anything and you're optimizing everything for your particular situation.
Excellent. I think that's the key is, not only do you need the answers to questions, you can read all you want to, but eventually it comes down to, what about me, right?
Exactly.
Your personal situations, these gentlemen are happy to help you with. After the break, we'll dig into who benefits most, income planning strategies, and how financial advisors should prepare clients for the coming changes. Stay with us.
Do you have a plan for how your assets will be handled after you're gone? Without one, the state could end up making life's most important decisions for your family. Through our partnership with Estate Guru, we make estate planning process simple and affordable, offering wills, powers of attorney, and revocable trusts. On average, our service costs 70% less than the traditional estate attorney fees, and you may even qualify for free financial and healthcare power of attorneys. Call our office today to get started.
And now back to our weekly question and answer segment.
Before the break, we outlined the basics of catch-up contribution changes, including Roth requirements and the super catch-up window. Let's unpack it a little further, guys. Are you ready? All right. Who stands to benefit the most from these expanded catch-up contributions?
The easy answer again is whoever's closest to retirement. So the people who fall in that 60 to 63 and have enough income to put in there, it's another big part. I mean, obviously they don't help you if you don't have that extra income, stand to benefit the most. The more money we can set aside for retirement, the more we have control of when we pay those taxes. So kind of the reverse of what we talked about earlier, where the government gets to choose when they tax you. The more you can put away if you fall into the right brackets of income, the more you have control over how much income you're going to pay right now, or income tax, I should say, you're going to pay this year, and also when you're going to pay it. We know that tax rates are likely to go up in the future, so saving right now might help us. Those Roth contributions might be another good way to say lock in our tax rates if we fall into that perfect kind of middle ground there. And then obviously it's just anyone who's 50 and older who's getting that catch up and taking advantage of it. It's going to benefit later in life in their retirement.
What should high earners know about the wage calculation used to determine those Roth-only catch-up eligibility we talked about? And how often is it reassessed? Is it one time and I forever get to live forever and ever with it?
No. So it's going to be reassessed on a kind of an annual basis, but on a backwards looking annual basis. So the way that they determine eligibility is actually not based on your like modified adjusted gross income, but it's based on your FICA wages. So basically the types of things that are going to show up on payroll taxes. That's going to determine your eligibility and if you're over the particular income thresholds, and that is assessed annually, but backwards looking. So it'll look, at your 2025 FICA earnings to determine your 2026 eligibility, and your 2026 FICA earnings to determine 2027 eligibility, and so on and so forth. So it is something where if your income changes during that time period, maybe if you're one of those people that are in that 60 to 63 bracket, maybe you scale back your work during that period of time. You don't fully retire, but maybe you go from working, a full 40 hours back to 30 hours. You might jump back under a particular threshold. So rather than the government saying, oh, you can only do these contributions via Roth, where you have to pay those taxes at a presumably higher rate than you would in the future, well, now you have full control, and you can decide whether you want to go Roth or pre-tax with those kind of super catch-up contributions. So it is something that's reassessed every year, but it is backwards looking to determine eligibility.
Sure. And I suppose if you don't always have to pay, deposit your W-2 job money into the accounts. You have accounts elsewhere, and it's strategic to put it into shift the accounts. Is that something you see people do?
So you can go about doing that. A lot of it just depends, with some of them, like the super catch-ups and stuff like that, a lot of those are linked to your employer accounts. So, it's like the same way you can't necessarily contribute to your 401k just out of your checking account.
Right.
But in terms of monthly budgeting and things like that, something that we've done before is kind of work around with clients like, okay, sure, maybe we're withholding more from our paycheck here, but we are filling that income from source B somewhere else. So there are a lot of ways you can go about, kind of manufacturing a similar income, even if you're actually having, like, say, more withheld from your paycheck to take advantage of these super catch-up options that are available.
Okay.
But as far as just going right, like from your checking or savings account, that'll be something like with an IRA or a Roth that you would still be able to do as well. So it's all going to be about determining what's the most effective route for you. Do we need to get, perhaps a little convoluted with our strategy, via extra withholding for our employer account, create income from Part B, or is it perfectly fine to just do kind of a straightforward contribution into an IRA or a Roth IRA? Just circumstantially gonna.
But again, not necessarily the ideal strategy. It's the ideal strategy
for you. Exactly.
Understood. Okay. And how can savers use income timing or deferral strategies, Roth conversions, deferred comp, those kinds of things, to stay under that Roth threshold?
So now they have to be a little bit more careful. Again, when we're looking at those taxes, you used to say, hey, let's start strategizing before. But when you come to those limits, you don't want to be kind of forced into making a decision that otherwise you had control over if you had gone about it another way.
Sure.
So like Ryan said earlier, it's about, maybe reducing some of that workflow. Maybe it's about deferring more of your compensation from the previous year, even though that's not, kind of a line for line kind of planning, but you can also look at, is this decision I'm making or is this last sale of the year, if you're a commission-based person, do I push it 3 days and wait until January 1st now, or do I continue to make it and have that be on that kind of final day of the year? So you're always looking to strategize with it. It's hard to get down to an exact dollar for a lot of people, so you're gonna have to kind of use your best judgment. The nice thing about a lot of these plans is if you do cross that threshold, you don't necessarily have to keep track of it. They do have it set up so those 401ks can automatically switch you to a Roth contribution if you cross that income threshold the year prior and say, hey, instead of me now having to go correct this during tax time so don't incur some penalties, the plans will automatically do that for you, which is kind of nice. Again, it's
shut off valve.
Yeah, but it's it's still going to be dependent on your plan sponsor and how they've set up the plan to see if that works. But there is ways to kind of do it at the end of the year if you fail to.
Okay, if you made an honest mistake in miscalculation.
Yeah, especially if you have variable compensation, variable income, that's going to be something you're going to want to monitor. If you're just someone who's straight salaried, you should probably have a pretty good idea. But if you're working in some sort of commission or just variable compensation job, that is going to be something that you're going to need to, manage and monitor as you get towards the end of the year.
Got it. Okay. And how should advisors, how do you guys incorporate these rule changes into multi-year retirement income planning? I mean, you're planning for 30 years and we're talking about 1 or 2 years of decisions. How's all this put together?
So one of the key things is you need to look at, okay, what do we want? Or where do we want our income coming from in retirement? What tax buckets do we want it from? What risk types do we want it from? What are other considerations? What is our retirement timeline when we looking to retire? If we're looking to retire after we are on Medicare, well, that simplifies the income situation quite a bit because now we're not worrying about healthcare premium tax credits and out-of-pocket maxes and things like that. You get right into kind of the Medicare system, which has its own complications, but is much more straightforward from an income perspective for the vast majority of folks. So that's the thing we run into probably first and foremost initially is trying to manage that. But then it's looking from a long-term tax perspective. Okay, how can we distribute income to ourselves over the course of that 25 or 30-year retirement plan, keeping more money ultimately within our family, whether that's, us directly as the retiree or ultimately then our beneficiaries down the road, and keeping kind of as much of it as we can out of the treasury in terms of tax payments. So it's multi-stepped. It's going to be different for everyone as far as prioritization and as far as how the different tax law changes we've talked about today are going to impact them. But as you are beginning to look at what we want to pull out, that helps guide us in terms of how we should put in during those, last few years of retirement. Maybe you do something in the short term that actually seems disadvantageous from a tax perspective because it is going to set you up in a more advantageous position once you get to retirement. So sometimes you do things that seem counterintuitive but are actually going to be better for long-term planning.
Sure. Okay. Now, I'm assuming that you asked all those questions. Those aren't answers you're looking for me. Those are things going around in your head. How much input in those types of questions you're asking do most clients have? I mean, for me, I've got an income goal. I want to set it. I want to get it. You guys handle the rest. Is that typically how people do that?
Yeah, most people are looking for guidance on that. Tax law is confusing, it's complicated. Most people just know, I've been putting this money away. I don't really understand how it operates. They're looking for help from us. We obviously look at those tax laws and try to make sure we're keeping you in those boundaries and doing what's best for you at all times.
Yeah, the key part is keeping them informed as you're going through the process so they understand what the kind of, tax bill and implications are going to be. But ultimately, like Ryan said, it's so often just looking for guidance.
Good. Well, hopefully some of that provided clarity to you. Also, if you were looking for what are the ideal strategies, not only the ideal strategies, but the best ideal strategies for you, make sure you call Buska Retirement Planning. They're happy to talk through with you, answer simple questions to talking about their entire process. So with that, we'll wrap up. Thanks for joining us today, guys.
Thank you.
At Buska, our goal is to streamline the retirement planning process to help you move towards a successful retirement with confidence and ease. Through our 3 companies, we create personalized comprehensive retirement plans by integrating investment management, income planning, tax strategies, estate planning, as well as health insurance and Medicare planning, all under one roof. Call today or visit retirewithbuska.com to schedule your complimentary, no-obligation consultation or to get a second opinion review of your current plan. Let's make retirement planning easier together.
And now, our Financially Speaking Weekly Desk segment.
Welcome back to Financially Speaking. I'm Cole Bruner from Buska Retirement Solutions, and joining me today is Ryan Pekka. And today, Ryan and I are going to talk about what Kevin Federline can teach us all about money management.
That's right. For those of you who don't know, Kevin Federline is the ex-husband of pop star Britney Spears. When he released his memoir, many speculated that he needed money as he was no longer receiving payments from Mrs. Spears.
Now, we don't know that for sure, though, do we?
We don't, and I want to be clear about that. Yes, there was a lot of speculation that Kevin Federline wrote a memoir as a way to generate funds after Miss Spears was no longer obligated to make payments to him as part of their divorce, but we don't know that any absolute certainty that existed.
So what do we know, Ryan?
We know how much her payments to him were. She initially paid him $20,000 per month. Her payments eventually increased to $40,000 per month. Over 17 years, she paid him a total of $5 million.
All right, so let's look at that as a hypothetical. If an individual received $40,000 per month, which is what some people make in an entire year, how could they really run out of money?
Easy, Cole. Lifestyle inflation.
I bet that's the culprit. Now, why don't we tell the viewers what lifestyle inflation really is?
Sure. Lifestyle inflation is when you spend more every time your income goes up. That's a problem because it can make it harder to pay off debt, save for retirement, or achieve other financial goals. If you're constantly inflating your lifestyle, you could wind up living paycheck to paycheck, which means you have just enough to pay your monthly bills.
That's true. So hypothetically, if your monthly income is greater than some people's yearly incomes and you're living paycheck to paycheck, you may be wise to cut down on your spending, right?
I would think so.
Again, hypothetically, how much would our friend, let's just call him Melvin Borderline, have had if he'd saved 10% of that money he'd received?
Sure, Cole. If he saved 10%, he'd have about $500,000. Now that's add in compound interest. Let's say for the sake of this example that Melvin received $5 million as a lump sum and invested $500,000 of that. With a conservative 5% interest compounded annually over 17 years, that would be over $1 million.
Okay, but if he continued to spend $40,000 per month, that would only last him a couple of years.
Right. That's why it's important to talk about lifestyle, because saving is important, but you have to be mindful of spending too.
Of course. So let's talk about how our viewers can avoid lifestyle inflation. Investopedia covered this in an article titled Lifestyle Inflation, What It Is, How It Works, and the Example. The first thing it reminds us to do is remember that because of our taxes, our actual take-home pay when we get a raise can be lower than we think. So look at what you're actually getting before you treat that pay bump as a bonanza.
Great point. Another important step is to set a budget. Ask yourself, is this lifestyle sustainable? Does it leave you room to save? If not, you've got to scale back.
We talked about this a bit already, but an emergency fund can be a much needed buffer. If an emergency comes up, you can cover it out of your fund.
Yeah. Another thing to consider as your income increases is to choose experiences over things. Instead of upgrading to a luxury car or buying a vacation house, considering taking a once-in-a-lifetime trip. Create some memories with friends.
Absolutely, that makes a lot of sense. Now, Ryan, a luxury car is a depreciating asset, and that vacation house could be a money pit, or at the very least, debt. Now, in my view, you don't want to get a raise and then set yourself back by taking on unnecessary debts.
Correct. Plus, there's what they call a hedonic treadmill. It's the idea that you buy something, like a luxury car, and it makes you feel great. But then that feeling wears off and you have to make the next splashy purchase just to get that rush.
And it's a treadmill because you do it over and over and over again, right?
Exactly.
Okay. Well, I bet people who are running on that treadmill don't make such smart money moves.
That's probably true. Here's another true thing. Big lifestyle upgrades can come with some hidden costs. You bought that luxury car, well, now you have to see a more expensive mechanic. A bigger house, you need someone to help clean it.
Of course. And sending kids to a fancier school can cost more than you think too. Tuition is sometimes just the beginning. On top of that, you have uniforms, supplies, extracurriculars.
Sure. Fundraisers too sometimes.
Yeah, definitely. So are we telling people not to upgrade their lives at all?
No, but we are suggesting that it may be a good idea to do it gradually. Consider a newer car, but not a luxury car, a slightly better house, but not a mansion, things like that.
Viewers, we hope that by learning about lifestyle inflation, you can avoid running out of money. Meanwhile, we've run out of time. If you want to talk more about lifestyle inflation and how to avoid it, visit us at retirewithbuska.com or give us a call at 715-355-4445. We'll be right back with more of Financially Speaking after this.
If you're 59 and a half or have recently changed jobs, now might be the perfect time to consider a 401k rollover. Rolling over your old 401ks could simplify your finances and give you more control from investment options and costs to how and when you make withdrawals. A rollover could give you the opportunity to partner with a financial services professional and tailor your investments to your specific needs, not the company's group plan. Call our office today to schedule your complimentary consultation and see if a 401k rollover is right for you.
With recent market changes, it's understandable that some people are feeling a little anxious about their financial future. That's why now might be a perfect time to review your financial plan. A financial services professional is trained to help you stay focused on the facts, not emotions, when it comes to your strategy. Getting a second opinion today works to ensure your investments are properly positioned to weather market volatility and that you're not taking on more risk than you realize. Let's work to make sure your plan is ready for whatever comes next. Call us today to schedule a complimentary review with one of our financial professionals.
Thank you for tuning in to this week's edition of Financially Speaking. We're glad you were able to join us today, and we hope you learned some useful retirement tips along the way.
On today's show, we covered a number of important topics, and hopefully we did so in a manner that was easy for you to understand. Now, this is the same way that we communicate to our clients when we meet with them in person. Remember, with the help of the right financial services professional, you can create a quality retirement, and our team is here to help. Right now may be a great time to get a second opinion on your current retirement plan. So call us at 715-355-4445 or go to retirewithbuska.com to continue your retirement education, catch up on some previous episodes of our TV or radio show, or to schedule your complimentary, no-obligation consultation.
If you have any questions or comments about today's show, call us at 715-355-4445 or feel free to send us an email at info@retirewithbuska.com. Please feel free to join us next week at the same time and place for another episode of Financially Speaking.